Let's get to our big mutual fund special, the biggest voices on our special Diwali edition. We spoke to Nilesh Shah of Kotak AMC, Navneet Muno of SBI Mutual Fund and Manish Gunwani of Reliance Mutual Fund on what's in store for Samvat 2075. Where's the next upside? What are some of the sweet spots for investors? Listen into this exclusive.
One, if you score, let's say, half a century on a very tough bowling pitch on the fifth day against most dangerous bowlers, and you score a triple century on a batting pitch with lousy fielding and lousy bowling and getting dropped 20 times, which score will give you better satisfaction? Numbers wise, triple century looks better, but in heart we all know that at 50 is worth its weight in the gold. So if you look at last year, market delivered roughly 10% return on Sensex. At 4% inflation, that's 6% real return. In the best of the time also, Sensex delivered 6-7% real return. So we are not way off from the average despite all the twists and turns and series of lower growth numbers. Second, when the news flow is bad, sentiments are bad, valuation obviously is also bad. And if you buy at low valuations, if you buy at cheap valuations, probability of making money increases immensely. Of course, it won't increase tomorrow, but who knows day after tomorrow. So this is the time to put your head together, understand that valuations are cheap, and if you buy quality companies run by good managers, I think there are better days ahead.
Manish, very simple basic question. Are we in for a long winter, which is bad will get worse before it gets better, or bad has already got worse, now it will get better?
Well, with the caveat that policy matters, we've all seen that government policy globally, whether you see US in 2009, India in 2002, policy has a lot to do with bull markets, how they shape up. But with that caveat, to my mind, I'm a bit more optimistic that in a very simple framework, if you look at the economy, typically historical data proves that the trend growth rate of an economy doesn't change very fast. So while we keep reading a lot of news, we think that the budget or something else has changed the trend growth of the economy. If you see large economies like US, India, China, they have a persistent trend growth rate, and what moves it away from the trend, to my mind, in India is only four things: monetary policy, fiscal policy, your exchange rate, and global growth rate. Now, if you look at those four factors, to my mind, last year was a bit of a perfect storm where everything was negative. But if you see the direction of all four, to my mind, it's marginally improving across the table. So to my mind, I think in 2-3 quarters, we should see a much better economy.
Nilesh, I never realized it at the early part of my career, but I'm glad I'm realizing it now, that we long-term investors should focus on two things: margin of safety and risk. So for a long-term investor, 3 to 5 years, define both these parameters, margin of safety and risk. How are they right now for equity investors?
So from a margin of safety point of view, there are 4 compartments in the market. Super large caps are pretty expensive compared to their historical average. Now, in a market where things deteriorate, they will provide safety. But from a valuation point of view, there is no margin for error. On the other hand, there is extreme and small cap, which is way below its historical average. They need a catalyst to give return, but margin of safety from a valuation point of view is the highest. In between are large cap and mid cap. The mid caps are reasonably well below their historical average. Again, they need a catalyst to give return, but margin of safety is pretty high over there, higher than large cap, lower than small cap. And the large caps are somewhere near their historical average. Margin of safety is reasonable, but again, they need a catalyst to deliver return. So growth could be one catalyst, precursor to growth, which could be additional credit flow, which could be FPI buying, which could be settlement to some of the NBFCs or banks which are in trouble. That could again change the sentiment and eventually change the fundamental. So if you have to look at from a valuation point of view, small and mid caps provide margin of safety, but they need a catalyst of growth or certain other things in order to lift.
Okay. Navneet, consumers are expensive and they were expensive 3 years ago. Quality stocks were expensive and they are expensive right now. But that's where all the returns are. That's where all the participation is. Now we may look and say, look, I'm a fund manager. I don't like them because they do not fit the way we invest or how investors have invested in the past. But if that's where gains are, what is wrong in chasing them? Because the investor would say, look, I don't care what you buy. I ultimately want returns.
So obviously, as echoing the views that Nilesh has just mentioned, that there are few stocks which have done exceptionally well. Most of them lie in the mega caps or the large caps, but there are few of the mid and small caps which are in that consumer so-called quality space where the return on equity is higher. You still see some growth in a low growth environment, and of course where the perceived governance is far better. They've substantially outperformed the rest of the market, and there is a large part of the market. So I measure one thing where the number of companies which have underperformed in BSE 500 index, the number of companies that have underperformed the index, that number is now more than 70%, and it's been increasing over the last few months because there's a small set of stocks which have been doing well. I think as the growth becomes more broad-based, if we are able to tackle the challenges that are there in the financial sector, as flows improve, last few days at least there are indications that even from the global investors, the flows have started improving. People would start looking at a wider set of universe, and then maybe the chase that you have for the perceived quality and pay any price, growth at any price or quality at any price, maybe people would start paying attention to valuation as well and would look elsewhere for value. I think maybe you just need a catalyst, as Nilesh just mentioned. Once we see that catalyst, I think it will become a lot more broad-based than what we have seen in last 1 year. This has been one of the very narrow rally. The 10-11% that has come from a very narrow set of stock, which is not good over a long period.
And you own those narrow stocks?
Of course, that's why the funds have done well. So touch wood.
Then there's a problem.
No, but we have expanded over the last few months. I mean, the idea is to spend a lot more time on those stocks where, let's say, the valuations have turned quite favorable. Maybe the near-term outlook is not as good, but you're waiting for that catalyst. And of course, markets will bottom, or the stocks will bottom much ahead of the bottoming of the economy and the profits.
We've all been waiting for this catalyst. We've been talking about it on a daily basis. But this government seems to be more into, incremental measures, unless they succeed with their divestment agenda. Everyone has been calling out for a massive spend, fiscal stimulus. Not sure if that's something that's going to come back. Is that the catalyst that you're hoping for, or are you looking at other things that could possibly help to stimulate growth?
I do think that a big strategic divestment from the government will be a big trigger, because it will do two things. One is both bond and equity markets are definitely worried about the fiscal situation and whether in the second half of this year, especially on the state government side, which don't have access to RBI reserves or other non-tax revenues, you could see a big squeeze on expenditure, because once tax revenues are falling short and you have to meet a committed fiscal deficit number, then the only option then is to squeeze expenditure, which pulls down the economy and you go into that vicious loop. So one is a big strategic divestment would address that. And two is, as we all know, there's a big segment of the market, which is the PSUs, which are very value-centric stocks. They have good dividend yield, price to book, price to earning multiples, which are very attractive. But they've been suffering from supply through ETFs. Also the fact that it provides a big catalyst for them, right? If there is a strategic divestment which happens 2x, 3x of current market price for one of the PSU stocks, I think that whole universe would get re-rated, and that will kind of pull up the index as well. So on both sides, from a macroeconomic perspective and from a market-centric perspective, I think that will be a big thing.
My next question is that, we always tend to focus on the upside. How much higher we can go, which sector will do well, which sector is going to be the next multi-bagger. None of those questions this time. But the question I would ask all of you is that before we start talking about the upside, let's talk about the downside. At the current price, with the environment, given where interest rate and oil is, Nilesh bhai, how much more can we go? What happens in the short term could be a technical factor, but fundamentally, how much more do you think? What is the worst case scenario? Let me put it this way.
So a lot will depend upon how situation evolves. If oil prices goes to 3-digit, obviously our markets will suffer. If today there is geopolitical tension in our border or outside, obviously there will be impact on market. When you're investing in equity, you have to take ups along with the downs. And as I mentioned earlier today, from a valuation point of view in small and mid-cap space, there is limited downside. It doesn't mean that what is attractive cannot become cheap or what is cheap cannot become cheaper. But then you'll have to add more. That's how the disciplined asset allocation works. So overall, if I see today, even last year, which was very tough, the large caps did deliver 6% real return. This year, it looks like corrective actions have been taken. Banking liquidity from May 19 is positive. Interest rates have been cut. PSU banks have been capitalized. In NBFC, some steps have been taken like securitization with first loss, though it has not yet become operational, but hopefully once you have announced, you'll make it operational. If you see the currency which was overvalued is now little overvalued around fair value, that will push exports. The strategic divestment is now right at the center stage and hopefully it won't be like last time's Air India. More importantly, with China, which has resulted into higher trade deficit with India, there has been discussion about curtailing that. This Chinese trade deficit is converting our manufacturers to traders. Hopefully, if we can curtail that, that will be very positive. So there are lots of corrective actions which have been taken, and coupled with valuation, I'll say there is limited downside in small and mid caps.
All right, that's the word coming in from the market experts, whether or not we're going to dazzle in Samvat 2017. Clearly, it's cyclicals, and that is clearly being looked at, and some opportunities within the consumer space.